Welcome to this Premier Training revision video which takes a look at inheritance tax. Benjamin Franklin is often attributed to saying, "In this world, nothing can be said to be certain except death and taxes." And whilst he might not have been the first to coin this phrase, modern inheritance tax regulations manage to combine the two. There's a lot of jargon involved with inheritance tax, so we're going to explain what it all means and how it all works. When a person dies leaving a will, then the executor is responsible for dealing with the tax due. If the person dies without a will, then it's the administrator who will deal with the tax. The basic calculation of inheritance tax is quite simple. First, you must calculate the value of the estate, then deduct the tax threshold of £325,000. Finally, you will charge inheritance tax on the balance at 40%. If the estate is less than £325,000, then there will be no inheritance tax to pay. When someone dies, everything in their estate is transferred to someone, even debts. It's the executor or the administrator who's responsible for seeing that the right people get the right property and cash and that any tax and debts are paid. Therefore, inheritance tax regulations refer to transfers. There are some exempt transfers. For instance, there's no inheritance tax to pay if the transfer is to a husband, wife or civil partner. In addition, if the transfer is less than £325,000, then the difference can be passed on to the spouse or civil partner to add to their own £325,000 exemption. It's also common for people to leave money to charities when they die. This is also exempt, and remember that this is not counted in the £325,000 exemption, so there could be tax benefits. Items or cash left at amateur sports clubs and museums are treated similarly. Transfers to political parties are also exempt transfers. If a person leaves land to a housing association, then this is also exempt. Remember that the exemptions are from inheritance tax and will not necessarily apply to other taxes such as capital gains tax. Cash or possessions given away during your lifetime may also be counted in your estate if you die within 7 years of giving the gift. Anything you give away during your lifetime that isn't exempt is known as a potentially exempt transfer. If you live for more than 7 years after the transfer, then it becomes an exempt transfer. However, if you die within the 7 years, then the amount will be added to your estate and could incur inheritance tax charges. There are some transfers which incur inheritance tax even before the donor has died. These mostly relate to trusts. A trust is an arrangement whereby one person, the settlor, gives property, money or goods to another person, the trustee, who holds the property as its nominal owner, for the good of one or more beneficiaries. For example, it's common for a trust to be set up for a child, whereby the child will receive the money or goods when they reach a certain age. There are many different types of trust, but in this course you will not be expected to know the different types. In any questions involving trusts, you will be told that it's a chargeable lifetime transfer. If an individual transfers property to a trust as a chargeable lifetime transfer, any amounts above the exempt amount of £325,000 become immediately chargeable to inheritance tax. The excess above £325,000 is charged at 20% and is usually paid by the trustee. If the settlor dies within 7 years of the transfer, then there's a recalculation of the amount due by the trustee. The amounts above £325,000 will be reassessed at 40%, and the difference between this and what's already been paid will be charged to the trustee. As with failed potentially exempt transfers, if the settlor dies within 7 years, then the transfer will be added back to the estate. There are also some additional allowances. For instance, £3,000 can be given away each year, and this is ignored for inheritance tax purposes. If all or part of this £3,000 allowance is not used up, it can be carried forward, but only for 1 year. Small gifts of up to £250 per person are also ignored. This small gift allowance cannot be carried forward. And certain marriage gifts are also exempt. £5,000 by a parent, £2,500 by a grandparent, £2,500 by one of the people getting married, and £1,000 by anyone else. Finally, regular gifts out of income are exempt as long as they aren't so large as to affect the living style of the giver. Examples might be payments to help with the living costs of an ex-spouse or civil partner, a dependent relative, or a child. I hope you've enjoyed watching this Premier Training revision video, and thanks for watching.